most people think Bitcoin runs on a clean 4-year halving cycle. Up, peak, crash, repeat. But when you zoom out, there's a bigger driver that often explains when and how hard Bitcoin moves: global liquidity, and that is global liquidity. So today, I'm going to be breaking down how Bitcoin cycles actually played out since 2009, what usually causes the rises and collapses, and what the halving really does and what it doesn't, and the exact macro and micro signals I want to time the risk on and off for yourself. Now, before we move on, I want to say thank you for being here with me. As promised, I'm going to keep doing short, sweet, and simple videos for you. I hope you enjoy this video. It's to the point. Let's delve right in. And if you are watching this video and are part of the 80% of you that are watching it and not yet subscribed, please go ahead and rip up that subscribe button. That would be truly appreciated. If you don't like it, you can always unsubscribe. Really simple. But for now, we're going to go delve right into the two engines of Bitcoin cycles. And before I do that, you need to understand that you should be watching this video here. I did say massive BTC and ETH warning to you yesterday, and even though I said patience is everything, I did warn you that 2 weeks ago that we're in danger. Even though we're at one of the most beautiful points on the rainbow chart, you need to understand right here, right now, my friends, that we are in a critical moment, and it's bad. You can see the thumbnail title there. That's not clickbait. That is just what it is. So in today's charts, we're going to see some of the craziest information that you need to absolutely, totally understand right now. The first thing is starting off with engine number one, which is Bitcoin's internal supply schedule, or halving block. Bitcoin cuts new supply roughly every 210,000 blocks, which is approximately every 4 years. And as you can see right here, right now, we're about 2 years, 100 days, and about 9 hours, 23 minutes. Could potentially happen on the 28th of March. This usually changes according to how many blocks have been mined. Now, halvings happened in 2012, 2016, 2020, and 2024. And the latest block was 840,000, reducing the block reward to 3.125 Bitcoin. Now, one of the most important things is that you can see that the supply, the mining blocks, every time the halving decreases, it gets halved immediately down to pretty much the end of the rabbit hole, right? And when you look at it from a technical cycle scenario that everybody kind of speaks about, where X amount of days after the Bitcoin halving, usually we have this pump, and you can see that there is usually a pump. This is a monthly chart, just giving you a heads up, and there are usually pumps. But at the end of the day, engine number two is external. Engine number two is external liquidity and risk appetite. So when financial conditions loosen, rates down, balance sheets expanding, credit flowing, speculative assets tend to levitate. When liquidity tightens, leverage dies, and Bitcoin usually gets hit harder than most. The key idea here is that the halving changes supply predictably, but price is set by marginal demand, and marginal demand is heavily influenced by liquidity conditions, and that is the M2 money supply. And as you can see, M2 money supply is breaking through all-time highs, is pretty much doing it on a day-to-day basis. And if you've been watching my channel and been subscribed to my channel, you'd know that we're probably predicting this to happen over the next kind of few weeks. But if we had to pull out the biggest bull flag of them all, which is a move from down here to up there, that is the move from 22 trillion up to 35 trillion that we could expect into this market over the next few weeks and months. Sorry, not weeks and months, over the next few years to decade or so. 10, 15 odd years, my friends. Now, I don't know how long that's going to take, but really, I think we're going to start seeing a lot more liquidity flow back to Bitcoin. And Bitcoin tends to follow the M2 money supply. How Bitcoin cycles actually played out is pretty simple and quite accurate. Think of cycles as 4 phases that repeat in different shapes. Accumulation, which is boring, low volatility and disbelief. Markup, trend up, it's back kind of narratives. Distribution is where mania, leverage, blow off top kind of behavior starts coming through. And a markdown, which is where liquidations, scandals, and forced selling happens, which I would say to you, we're probably in number 4 at this point, which is what we would consider to, of course, then be a markdown on the chart, right? You can see that's a heavy markdown. That move from there to there is pretty much the move from there to there. It's quite significantly similar, and I'm going to point out a few things to you in the charts in a short little moment. You just need to hold on to your socks right now. But the historical rhythm that many people point to is the halving. So the vertical green lines are the 2012, 2016, and 2020 and 24 halving. Okay, and as you can see, basically 2012 halving was, and then the next year, the following year, we had 2012 we had the halving. Then we had 2012 we had the halving. The following 2012 we had the halving. The following year we were macro bullish. The following year we collapsed. Then we had the halving, we had the bull run, and we had the crash. Okay, then we had the halving. We've had a little bit of a rally. We've been experiencing some sort of crash, right? So there's a bit of a nuance here. Those peaks, those crashes also align with macro tightening and liquidity shocks far more consistently than the halving date itself. We'll discuss this in a short moment. What actually causes Bitcoin to rise and what causes Bitcoin to crash? Bitcoin tends to rise when a few things stack together. A, liquidity improves, the big one. That, as I've just shown you on US money supply, that makes it easier. So when money is easier, leverage is cheaper, and risk assets catch a bid. Multiple analysis and recent research note meaningful relationships between Bitcoin and measures the global US M2 growth, often with lags. And generally those lags end up being approximately 8 to 12, maybe 14 weeks at the most. So new buyer channels open. Example, spot Bitcoin ETPs were approved in January 10, 2024, expanding access for traditional investors, which we can now see are pretty much taking over the show, right? The supply narrative tightens, and the halving effect gives us a supply and demand effect in the market, which means that the halving reduces the flow of new BTC that is essentially sold by miners, all else things being equal, of course, and that's a real structural change. It doesn't guarantee the timing aspect. And here is where I'm starting to get into the point of the title of this video, because reflexivity kicks in when prices rise, attention rises, inflows rise, leverage rises, price rises, until it actually all just breaks and the house of cards come tumbling down. And unfortunately, that is precisely why I'm about to talk about what causes Bitcoin to actually collapse. Now, we're going to look at this because we have, as I have mentioned to you, we are in the falling wedge pattern. I did say to you that we were probably going to break down lower and end up somewhere down here in the 75 to kind of 74, maybe even 71 region. Now, I still believe that that is possible. There is volume right now to currently back the existing 4-hourly candle, which has broken below that support level. It has not yet broken below there, which, as you can see, is quite a bit of consistent behavior. But what causes Bitcoin to collapse? Well, Bitcoin collapses when forced selling overwhelms natural demand, and the usual causes are liquidity either tightens up, either rates, QT, strong dollar, credit stress, and this is when dip buyers disappear and leverage becomes the enemy. And that's when you need to be using no leverage or 1, 2, 3x leverage at max, my friends. Right now, you can see my Ethereum trade is still on the table and it is still bleeding right now. I did tell you that I have a buy limit on my ETH trade, but the point being is that Ethereum will follow Bitcoin, and as you can see, the 4-hourly candle has literally just closed and changed, and you can see we have far greater dump right now busy happening than what we have had buy power in the last few days. Now, my friends, that is a signal to us that we are heading down, because the leverage buildup on the leverage buildup and the liquidation cascades, because perps funding gets euphoric open interest rate spike, then one dump triggers margin calls and it ends up becoming a chain reaction. Now, as you can see from the Bitcoin liquidation heat map, this is the 2-week, but I'm going to go a little bit closer into the liquidation heat map, as I did for you and pointed out to you on this video yesterday. Go check that video out. But for now, this is the 2-week and at a 75 threshold. And as you can see, there's liquidity above us all the way up here. So I have no doubt that we will experience some sort of relief in a short moment. But currently, the liquidity is grabbing whatever is beneath it and hitting out these areas. And please remember that at 5 a.m. tomorrow morning, we have what would be an event, a systematic potential blow up. And the Japanese are potentially raising their interest rates as of tomorrow AM, 5 a.m. Central African time. And, you know, really, that could send a massive shockwave into the market. And I foresee us grabbing the liquidity below us, okay? And as you can see, the liquidity is on the 2-week time frame is really telling us like we can't really push below 80, 81. And my friends, this is the sweet milk spot of the milk and cookies of this video, is that the institutions, ETFs and ETP buys have an average buy entry of about $80,000 per Bitcoin, which means that they're not going to really want the boat to go much further, although I'm sure they would love to scoop up more, but it starts to put them into a potential red and liquidation for coming scenario, although we all know that they have enough capital to buy the dip themselves. And the last point would be then the miner stress. Sometimes post-halving, weaker miners can capitulate, and if price doesn't rise fast enough, they start to add selling pressure to ensure that they can cover costs to run their mining rigs. Now, what I want to get onto you in a short moment is, do halvings cause the actual 4-year cycle? The clean answer to this video, and this answer we'll reveal in a short moment. But just remember that we're probably going to bounce down, and then in the afternoon we have non-farm payrolls. Non-farm payrolls are very much going to end up very likely looking positive for the US, which means that the Japanese, being the strongest currency pair with the dollar, and obviously the Japanese carry yen trade being in existence, and a triple witching event which happens tomorrow as well. There are mad points of news. There are crazy things happening out there. The new moon is tomorrow at the end of Sagittarius, heading into Capricorn. And my friends, all I want to say to you is that this absolute beautiful shedding of the past has come to its final realization. wherever you're going to put in your entries into Bitcoin and crypto, use my Bybit link down in the description of this video below. My friends, you can grab yourself up to $30,000 deposit bonus, and you can see Bitcoin is trying to bounce back right now. I don't think so. I think we could just retest the break zone, which it's currently doing, and we're going to continue down. I do believe we're going to continue down, and that is just really the end of it. And I will continue to share with you and show you where I will be adding to my trades and my positions. But for now, the halvings do create a natural 4-year cadence because they're programmed about every 210,000 blocks and reduce the new supply each time. But here's the kicker. The halving alone doesn't explain the full cycle, especially the timing of these cycles. In modern markets, liquidity, conditions, and demand channels, ETFs, regulation, risk appetite, we understand what is happening in US regulation around crypto and blockchain assets at the moment. Those particular things can either stretch or compress or even partially break the classical system. And as we understand, crypto and blockchain are essentially about to tokenize everything. That is going to take place on Ethereum, and Bitcoin being the #1 store of value asset, the digital gold, and Ethereum being essentially the new age internet. My friends, we are about to witness the most beautiful times, and you're still very early right now. If you can open your blinkers and look at this from the eagle's perspective, we're going to see the entire view for what it actually is. And you should focus then on understanding that the following thesis of the 4-year cycle is not a law of nature. It's a story that often works because halving is driven by supply tightening frequency that happened in the same general era as liquidity or risk cycles. And liquidity can dominate, and that's why we see what we see. So what is the most important thing for you to watch and check on your checklist? First of all, you need to absolutely obliterate the like button on this video. And then secondly, if you're watching this and haven't subscribed, please go ahead and subscribe. And if you are still here with me on this video, I appreciate this. Now, the following is going to be your macro signals checklist. And the first thing is, of course, your global liquidity trend, remember, which is broad money growth, central bank balance sheets, and proxies. The Fed policy direction, cuts versus hikes, tightening versus easing, right? Real yields, which are higher real yields, usually pressure risk assets, and dollar strength, or the Dixie, dollar strength often equals tighter global conditions. Right now, the dollar is weakening. If you went and watched my video from last night, I will leave it pinned in the cards above for you. But when credit spreads also widen, it takes stress and risk off, becomes the narrative. So new structural demand, ETF flows, and regulatory shifts are currently happening. Those are your macros. Now, your minors, my friends, your minor or micro checklist is really the leverage temperature, where the perps funding, open interest, where the liquidation levels are at, whether there's on-chain valuation and supply and demand, where the supply and demand is, your MVRV scores. You can use multiple tools on TradingView. Use my TradingView link down below to get yourself a discount on TradingView. It's an incredible trading platform. And of course, realized cycle regime context, supply dynamics, exchange balances, long-term holder behavior, minor health, hash rate trend, and minor reserves capitulating, narrative positioning. Everyone is either bullish, plus there's leverage, equals signals of danger. So the rule of thumb here, my friends, and if you are still with me, I'll leave you with the following. If liquidity is improving and leverage is not yet euphoric, that's often the best bull phase window. And if liquidity is tightening and leverage is extreme, That's when crashes are born. Halvings change Bitcoin supply mechanically, but liquidity changes demand dynamically. Price is set at the margin, so liquidity often decides whether the halving becomes a small bump or a full-blown super cycle. If you appreciate the video, make sure that you are currently subscribed to the Crypto Bliss community. I appreciate you and thank you for being here. See you on the next one.